All right, in this video, we're going to do a deep dive into the ETF strategy. We're going to talk about how the strategy actually works, show all the evidence proving that it works, and then we're going to talk about how to actually run this thing in practice. So we've already kind of touched on this, but the idea behind the ETF strategy is two ideas. The first is an all-weather portfolio idea from Ray Dalio. The idea there is, hey, if you combine a bunch of different assets that perform well in different market regimes, you can achieve a very smooth return because regardless of the overall economic cycle, you have something that's generating some money. And then the second idea within the ETF strategy is momentum. So we lean on a couple ideas from a guy named Rob Carver, who's written a lot about the idea of momentum trading. We take a couple of the ideas related to using moving average crossovers as a way to trade momentum, and we layer that on top of the ETFs in our portfolio. So the 5 ETFs that we are trading in this portfolio are SPY, GLD, TLT, DBC, and FXE. And these ETFs are giving us exposure to equities, to gold, to bonds, to commodities, and to currencies. So the weighting of each of these assets is not equal. And in our portfolio, we have it set up as 35% of NAV, or your capital that you start with, is allocated towards S&P, 30% is allocated towards bonds, 20% towards gold, 10% towards currencies, and 5% towards commodities. And the way you calculate these percentages is based on the net asset value of your portfolio. So let's say, for example, you put $10,000 in, the net asset value. So if everything was liquidated in your account, the cash balance remaining is 10,000. And so 35% of 10,000 would be 3,500. And that would be how much money we allocate towards buying SPY. We would buy as many shares of SPY as we could that bring us up to that $3,500 mark without going over it. And so at the end of it, we would probably still have a little bit of a cash balance left because there just wasn't enough to buy any more shares while staying under that capacity that we've set for each of these ETFs. There are two times that you make adjustments to this strategy. The first is every single Friday, you just rebalance back to these target weights. So 35% SPY, but let's say SPY rallied really hard and now it represents a bigger portion of the portfolio, maybe 37% or 38%. Well, every Friday, you're going to bring it right back to that 35% cap, and you're going to do that for each of the ETFs. Now, keep in mind, in the Predicting Alpha terminal, the way that this would work is you would just get a message in your email that says rebalancing time. You would sign in, and it would tell you exactly buy 3 shares of SPY, sell 2 shares of FXE, buy 2 shares of TLT, and then you're done. And you would just input the prices you got filled at. It would track it all for you. That's it. Doing it manually, you just have to go calculate based on the new net asset value of your portfolio. How much do you need for each of these tickers, right? Like 35% of my new NAV, that's what I buy for SPY, 30% for TLT, and so on. Now, the second time that there is a rebalancing or adjustment required is if there is a change in the moving average signal. So the moving average signal we're using for this strategy is the 64-day moving average crossing with the 256-day moving average. Or simply put, it's the 1/4 of the year moving average versus the 1 year moving average. And so long as the 64-day average is above the 256-day average, we are in these positions. Let's say today, at the time we run our signals, which is 3:30, for SPY, the 64-day went below the 256. There would be an email sent to you saying, hey, rebalancing required. And what it would be telling you to do is close out of that SPY position. So we would then be in 35% cash for so long as SPY's 64-day moving average remained below its 256-day or 1 year moving average. And to be clear, like if all of the 64-day moving averages went below their 256 moving, we would be in cash entirely for that strategy, so long as they don't come back. And once they come back, then we get back in. So think about what we're doing there. This is basically tracking the trend of the stock. If the stock goes down a bunch, we're going to get out of the position, saves us from major crashes. We also do miss some of the recovery though. And that's what leads to us having a very smooth P&L, but also not as high as it would be if we accepted bigger drawdowns and then allowed it to run more as well. But that's okay because this is meant to be a bedrock for the portfolio. It's meant to be the stable thing that we build on top of. It's not meant to be the real return generator. We'll get to that in the VIX strategy in the next video. So now let's look at the historical evidence for this strategy. Here on the screen, this is what the equity curve looks like for this strategy in particular. You can see it's a beautiful straight line, very nice. We all wish our portfolios looked like this. And if we look down a little bit, you can see a very similar chart to what we looked at for the overall strategy, where we have a starting balance of $100,000 and an ending balance here of $270. We can see that over this time period, it made a 5.53% compound annual growth rate. So lower than what you would get from the market. But what's also also important to see here is that our max drawdown is just 12.9% compared to the S&P, which had a 33% drawdown over the same time period. So sure, this strategy has a low CAGR, but it also has low volatility and a very low max drawdown, and that's what makes it the bedrock of the portfolio. One thing that's interesting to note about this test is that for the ETF strategy, we actually have a bit of a longer look back window since the data is available longer, and we can see what happened in 2008. So in 2008, the S&P 500 had a drawdown of about 50%, like a huge drawdown that everyone pretty much had to suffer through. But with this ETF strategy, the max drawdown during that time was just 12.93%. So the S&P was just drastically worse with the momentum signals and the diversification. We may not make as much money just on this one strategy, but it's a very smooth return, right? Our worst drawdowns during times of absolute crisis are still completely manageable. Now, when it comes to running this strategy using the Predicting Alpha tools, it's really simple. There's literally just one page in there, which is the combined portfolio of the two strategies. Whenever there is a rebalancing required, you will get a notification. The terminal will go from being a green and healthy color to an orange and alert color, telling you that something needs to be done. You literally just click rebalance now, follow the prompts. It'll tell you exactly what you need to trade. And then from there, all you do is place the trades, put in the prices that you got filled at so that the terminal can track your P&L for you, and click complete. That is literally it. All of the math, all of the data science, everything is handled for you. Your job, which is the job you wanted when you started all of this, is to place the trades. Now that we've gone over everything for this strategy, let's hop into the next video where we are going to talk about strategy number 2, which is the VIX strategy.